Hey everybody, welcome back. We're on Unit 4, the financial sector. We are on the first subcategory, 4.1. It's called financial assets, and this is part 2. And in this part 2, we are going to be looking at the relationship between bond prices and interest rates. What is that relationship? And I'm going to go ahead and give you the answer right now. It is inverse. When interest rates go up, bond prices go down. And when interest rates go down, bond prices go up. It's an inverse relationship, okay? But let's understand why. So that's what I've got all this over here for. So first of all, I've got the financial market up here. You can see that. That's where borrowers and lenders come together. Another name for the financial market is the loanable funds market, or at least in this class, we use those two terms interchangeably. Financial market, loanable funds market, we use them interchangeably. Technically, the financial market is a little bit bigger than the loanable funds market, but for all intents and purposes, in a macro 101 course, you can just think of those as the same thing. This is where you go if you need financial capital, okay, money, and this is also where you go if you have excess financial capital and you want to get a return on that financial capital. This is where bonds are originally sold, okay? So when they are issued, originally sold, so those two terms are interchangeable. When they're issued, when they're originally sold, they're sold in this market, which is the primary market, okay? It's a new term for us. In the primary market, that's where the actual issuance of bonds happens. That's where, like, I'm a corporation, I need money. I go to the financial market, I issue bonds. That's right, I sell bonds in order to get money. The lender, the person, the creditor, the lender, the person that gives me the money, they want the bond. They want the debt instrument. They want that piece of paper that says, hey, I owe them money, okay? So that's what happens in this primary market, financial market. Now, once the bond has been originally sold, it then goes into this market called the secondary market. And that's where bonds can be sold again and again and again and again. That means the same bond that was originally sold in the financial market can be sold again and again and again in this secondary market. As you can see, I've made the secondary market box bigger, okay? Because it is a bigger market, all right? This is where most bond selling happens. Of course, yes, lots of bonds are sold here, but every bond that is ever sold here ends up here as long as it has not matured or expired. Okay, now let's talk a little bit more details about the bond. When the bond is originally issued, there are three major things that are printed on the bond. It's face value, okay? That's the amount the borrower is usually trying to borrow, all right? The interest rate, and the maturity date or expiration date. That's right, the maturity date / expiration date. Those are the same term, okay? When it matures, it expires. Those three things are printed on the bond. Now you'll notice I've written the bond price above the bond. That's right, it's not printed on the bond. Why? Because the bond price can go up and down over the life of the bond, and that's what we kind of want to understand in this video. So, let me give you an example. The government, they need money. They're running a deficit, okay? And so they need money. Basically, their government outlays are greater than their taxes. They've got a deficit. Where do you go if you need money? You go to the financial markets. They head to the financial market, and they're going to issue a bond. That's right. They're going to print a bond that says U.S. Treasury Department, meaning this is a debt instrument of the U.S. Treasury Department, meaning this bond is going to represent debt of our U.S. government. They're going to sell it, i.e. issue it in this market, okay? Now, right when they're about to issue it or sell it, okay, they're going to print the face value, and we're just going to say that's $1,000, and they're going to look at the loanable funds market, where suppliers of loanable funds and demanders of loanable funds come together, and in that market, they're going to see what the going interest rate is. We're going to say 10%. And then they're going to put a maturity date, and for right now, we're just going to say 10 years into the future. So, face value 1,000, interest rate 10%. What does that mean? That means whoever ends up holding this bond, the United States government is going to pay that person $100 annually in interest, okay? So how did I get that $100? 10% printed on the bond, face value, 1,000 also printed on the bond. So no matter what, the life of this bond, anybody that has this bond, the U.S. government's going to pay them $100 in interest, okay? Now, let's say that I buy this bond in this market, okay, which is kind of weird because individuals often don't buy bonds in this primary market. They buy them down here. But just for the sake of this example, let's say I buy this bond in this market. And let's also say that when I buy the bond price and the face value are the exact same, which is fine to think of conceptually in this primary market, that they would be the same thing. So I spend $1,000 for this bond, all right? Now, one day goes by and I wreck my car and I end up needing money, so I need to liquidate this bond. So what does that mean? I need to sell this bond and turn it into cash. Now when I go to liquidate this bond, to sell this bond, I'm going to sell it in the secondary market. This is not the bond that I printed. This doesn't have my name on it. This is the U.S. government's bond. I'm just going to sell it to somebody else, okay? So I'm going to go to the secondary market and I'm going to sell it. But I'm also going to say, in that one day that went by from when I bought the bond here, interest rates went up to 11%. So that means when the government goes to issue new bonds in this market where bonds are issued, they're going to put 11%. This is still going to be 1,000. This is going to be 10 years from the day. And what that means is the new bonds, whoever holds the new bonds, they're going to get paid $110 in interest, all right? So what piece of paper would you rather have? The piece of paper that will pay you $110 in interest every year, or the piece of paper, my piece of paper, that will pay you $100 in interest? Well, of course, you want these new bonds. So the bond price, the thing that does fluctuate, that's not printed on the bond price of these bonds, because the interest rate has gone up, all these bond prices are going to go down. They're going to sell at a discount. That's right. If I were to sell my bond, I'm not going to be able to sell it for $1,000 anymore. I'm going to have to sell it for less. And why is that? Well, when I sell my bond for less, the yield or return of my bond will equal the return of this bond. And so how does the yield or return equal it? Well, if the bond price goes down, if the person who's going to buy this bond has to pay less, okay, and remember, they're still going to get $100, that bond price can drop so as their return now equals 11%, that new interest rate. Hope that made sense to you. Let's make sure we got the takeaways. What happened to the interest rate? It went up. And when the interest rate went up, what happened to bond prices? They went down. Remember, that was our original thing we said from the beginning. There is an inverse relationship between these two. And guys, if those interest rates in that 24-hour period that went by, if they happen to have gone down instead, okay, my bond would sell at a premium. The bond price would actually go up, okay? So there it is. The relationship between bond prices and interest rates is inverse always 100% of the time. Now, just a little addendum to this, okay? Another way to somewhat think about this in the context of our class is oftentimes we're going to be asked, if the Fed wants to do easy monetary policy, what's going to happen to bond prices? So let's just walk through that very quickly in a little bit different way of thinking about it, but also a way that's always going to get us the right answer. If the Fed wants to do easy monetary policy, that means they want to be easy with money. That means they want to get more money into the economy. They want money easier to get, so they got to get money into the economy. So what is the Fed going to do? The Fed is actually going to go to the secondary market almost every time. They hardly ever go to the primary market. Okay, they're going to go to the secondary market, and they're going to buy bonds. They're going to demand bonds. That's the key I want you to hear. They're going to demand bonds. So what's going to happen to the price of bonds? They're going to go up. Fed's going to get bonds. They're going to hand people money. What's going to happen to the price of money, which is the interest rate? It's going to go down. So again, we get the right answer. When the Fed demands bond prices go up, interest rates go down, inverse relationship. Anyhow, hope that made sense to you. We'll see you in the next video.